Hey guys. Just wait a few minutes for people to join. Hello. Hollis.
Hello.
How are you? You all right? You hear me?
Hello.
Can you hear me? Hello. Hello?
I can hear you.
You
Can
can't
you hear me?
Yeah, I can hear you. Yeah. Yeah, I can hear you. Can you hear me?
Hello.
Hi. Can you hear me? Hello? I'm confused.
Hello. You can hear, I can hear you now.
You can hear me? You can hear me?
Yeah. Hi.
Well, I can hear echo now. So I can hear
Right.
I can hear myself when I speak.
Right.
So you yeah, you might have to be on mute, otherwise I'll hear echo. Can you still hear me? Give me a thumbs up if you can hear me. No? Can you hear me? All right. Anyway, why don't we kick off? All right. So welcome to the hedge call, everyone. So this, thanks for being a participant of the hedge. And I think we've got Brent joining. I don't know if that's the Brent or if that's a different Brent. But basically, yeah, I'm here to answer any questions you might have on all the material from junior trader to senior trader to portfolio manager. I suggest we use the first 15 minutes for the more basic stuff. So any junior trader questions anyone has, let's stick them in the chat, or feel free to speak via the camera and the mic. I'll try and make this as interactive as possible. Can you hear me all right, Hollis?
Yeah.
Okay, good.
Yeah.
I can hear you now as well, and without an echo.
Good.
Perfect. Cool. Welcome. I saw you were on the call last week, I think. Yeah.
Yeah.
Yeah. Cool. All right. So who's got any questions? Who wants to kick it off?
Well, I'll go first then.
Yeah.
Yeah. Last week you went over how to monetize puts.
Okay.
If you remember. Yeah. I'd like to ask this week about managing calls. So just say I started with a 30 delta long call, and then it reaches 50 delta. So now the risk reward is skewed. It's not in your favor anymore. It's like more 50-50 in it when it reaches that 50 delta. So how do you manage that? Do you like roll it, or do you like leave it, or do you buy puts to hedge?
Okay, so I pretty much never buy puts to hedge a long call. That just wouldn't be on the menu really. It just doesn't, yeah. Because all you're doing there is you're adding vol as well, right? It's like you've bought some calls, you've got some vol in those calls, you've got some Vega in those calls. Market's rallied. I don't think you're going to buy puts to hedge it. I don't know if I've hardly ever done that basically. So the whether you roll them or not is really going to be a function of your conviction on the stock, the leverage that you want, because a lot of the time with calls, is you think we're going to bounce. You've like bought a dip or something. You think we're going to bounce, but you don't know how big that dip. You don't know how big the rally is going to be. You don't necessarily have that strong conviction that it's just going to keep flying, right? So actually, when a call goes in at the money and goes through strike, rather than wanting to roll it up, that's often you kind of breathe the sigh of relief that, okay, now I really am long this underlying, basically, right? Because when you buy calls, the worst thing is, it's like often you can be right about the direction, but because it doesn't happen fast enough, they always stay out of the money and they never make it. And they're always bleeding, they're always decaying away. And there's what we call that the calls with no delta, right? So if you go too low delta on a call, like a 10 delta call, often you can be right about stock rallying and make no money because that call just never appreciates, because the theta bill, because it's too short dated, basically makes the delta shrink, it makes the premium shrink whilst the stock's rallying. So it just stays the same price the whole time, basically, right? So when I'm buying calls, I definitely want calls that I think have got a good chance of actually going through strike. Yeah. And then once they get through strike, rather than actually selling them, depending on my conviction on stock, I might sell a higher strike to turn it into a call spread, right? So I've basically monetized it by selling a higher option and banking the fact that the premium of that higher option I'm going to get to collect if the stock goes back down. Yeah, that might be one way of doing it. I think the rolling up of calls only really happens when you've got very strong conviction that this thing can explode higher, basically, right? That's kind of how I feel about it. It's not something, yeah, it's not a no-brainer to roll those calls up, basically. Yeah. Sometimes you just take a percentage of them off, right? You could just scale out of them, right? That's another way of doing it. Yeah.
Right. Thanks.
Yeah. Anyone else? Come on, guys. This is your opportunity to ask me anything within reason. You can put it on the chat. You can say it. It's up to you.
Hey, I got one for you.
Yep. Who's that?
It's Brent.
Oh, yo, Brent.
So, man, how you doing?
I'm good.
So yesterday, everybody was trying to play a rally. I think we were all waiting for it. We all thought it was coming. And so I'm curious, based on everything that was going on. I mean, vol, was backwardated. There was obviously a lot of velocity in that drawdown. If I wanted to play a dip, let's say I had the timing right, 40 to 25-ish, given that implied volatility is likely to come in and some of these other dynamics, what kind of trades do you look at if you wanted to try to play some type of a short cover rally like that, right? Do you look at just outright calls? Do you look at call spreads because you want to offset the volatility, the volatility crush? I mean, it kind of sinks what you were talking about before, where you can buy calls, but vol comes in and you don't make as much, right? So
yeah, so I would very rarely use outright calls because they'll just look very expensive. And you kind of want something that doesn't rely on you being immediately right? And isn't decaying at like some monster rate, basically, right? Now the question is, you want to play a bounce. Do you want to play a bounce in a way where you can monetize it quickly off a 100-point rally, or is it a more medium-term view that you want to hold for a couple of weeks, right? That matters in making that decision, basically, right? So if you're willing to hold the position for a couple of weeks, then yeah, a call spread's a no-brainer, right? You do a call spread, it carries well, you rally up towards the short strike, you sit and collect theta, and you've got some long delta on. It's pretty decent. It does what you want it to do, and you're not worried about monetizing it off an immediate rally. If you want something that you can monetize quick, then you kind of have to go outright, and the problem with that is it's expensive, right? So the sort of trades that I'm using right now to buy the dip, because I am trying to buy the dip in S&P, failing abysmally at the moment, but trying. Kind of trades that I'm doing are call spread, call ratio type trades. I did a March, like earlier before the market really shanked yesterday. I did a March 47.5, so 47.50, 4900 call ratio, 1 by 1.5. So not too aggressive a ratio, 1 by 1.5, so I don't get into trouble if it rallies really fast. I then did a fly structure, March again, when the market lowered down, I did a 46, 48, 49, 50 call fly. So I basically tightened up that top strike a little bit lower. It ended up costing me 25-ish. I think that structure did. And I basically, the way I see it is if the market smashes higher, the worst that I'm going to do is I'll make 50 off spending 25. So I double my money. Yeah.
What are your dates on that?
March, mid-March.
March.
Yeah. So the way I see it is like, you double your money above 49.50, right? Because you've spent 25 to make 50. If you manage to get and gravitate towards 4,800, which actually probably is going to act like a bit of a pin, considering some of the positioning in February that's going on. I want to ask you about that actually. Then I think you could make 100 points off that and you spent 25. So I quite like that. That buys you 2 months pretty much. We might chop for another week or two, post FOMC, post month end, and then maybe we can look past this rates repricing and actually get optimistic about Omicron being the end of the pandemic and having some sort of reopening impulse maybe in some of those cyclical sectors that, the underlying commodity market is doing fine. Like oil's going nowhere, right? So I kind of feel like there is a rally that wants to happen under the surface, but right now the big cap techs aren't letting it happen, right? So, and we've got earnings as well, right? Earnings aren't a disaster, then that might be a positive catalyst as well, right? But let me ask you a question. I'll throw it back at you. So Sam Carson mentioned these call spreads that keep going up, right? February 47, 48, 46, 48, or whatever the hell it is. That is a monster position now. Is that one that's come up on your radar in your strikes and stuff? And are you accounting for the fact that the 47 area is actually a short strike and not a long strike? Because your model would normally assume, because it's an upside, it would be a long strike. But we know that clients buying it, which means dealers are short it. So do you reflect that in your model? Because when it's 50,000 listed options, it ain't small. It's actually it could flip the sign of your gamma model, basically, right?
Yeah, and that, so one, our model won't adjust automatically for that. Two, you bring up a very good point, but I think just in general, the market is dominated by put options right now. So if you look at what all the gamut is at all the various strikes, there are very few call positions at anything below 4,400, call it, certainly. And the net gamma doesn't flip, we don't think, until over 4,600. So whether or not you want to weigh calls as being sold or bought by dealers, the fact of the matter is that there's no call interest anywhere near current levels. Mm-hmm. And so just in general, I view that when a market is embedded in call options, the volatility will tend to come down. And I think that has to do with the calls sensitivity to volatility and also the way that they're traded. But you bring up an excellent point. And I think what the key here is that I don't think that there's anybody in their right mind that's going to think that most calls coming off of a 10% drop in markets, that most people are going to be selling calls if we start to rally, right? So, you kind of need to handicap that, certainly in the core gamma model, with just the fact that, look, you're going to be selling cheap calls in the face of what could be a very vicious, even if it's just a dead cat bounce, right? We could get we could rally 5% off of basically nothing, right? So
easily. Yeah.
So you bring up a really good point, and it's something that we need to handicap on our models. That, look, you want to be long volatility here, you want to be long gamma in these situations. And you're right. If we do get up into that 4,700 area, those call spreads could add a little bit more fuel because they are long positions. And interestingly, I think that this is kind of turned away from, I guess, the Q&A of the session. But, if you look at the backwardation in the market yesterday, there's all sorts of extreme readings in the market in general. And so I want to flip this back to you. I think we've hit this area now in the market where the downside protection is so expensive and the move has been so major in terms of selling that the cost of hedge protection is very high right now, right? And you would need another catastrophic move lower for that hedge protection to pay off. So if based on that, when you're sitting in your bank seat or whatever, you really can't buy hedge at this point. I mean, you can, right? And you maybe need to structure and change it, but let's face it, the time for buying puts was last week, right, or 2 weeks ago, not necessarily yesterday,
funny
right?
because we had a conversation a week ago, right, before expiry, and you were saying, why is the VIX not spiked? And I was like, because we haven't broken spot levels yet. And I said, if we broke below, can't remember what level we had talked about, but I said, if we broke 4,400, I said, vol would go nuts, right? And that's kind of what happened.
Yeah.
And let me answer someone's question. Hi, Imran. Last week you mentioned VVIX ratio. How do you use it practically in your trading? Do you record the ratio and use it as a signal to get in or get out? I don't use it as a signal, no. I mean, actually, I didn't even personally use it very frequently until I started following Darius Dale at 42 macro. And he uses it as like one of his risk indicators. So if he sees the VIX ratio breaking down, that means that the VIX is out rallying the VIX's volatility, which means people's conviction about needing protection is high. So rather than buying call options on VIX, they're buying outright VIX futures. And that's quite a bearish kind of structure. That's quite a bearish sentiment. And so he sees that as a risk off indicator. He's back tested it. He's seen some value in it. That's why he's incorporated it in his models. It's not something I ever really used. I mean, when I used to trade for banks and stuff, I used to trade VIX options a lot to just sort of fade vol spikes and things like that. So I would monitor how expensive VIX options were to see if it was worth buying them or not, or whether they were just too damn expensive. They didn't give me the leverage that I wanted to play the move in vol that I was looking for. But so that's really the extent to which I really looked at and monitored VVIX, just to get a feel for if VIX options are just too expensive to buy. But I typically wouldn't be a seller of VIX options ever. So yeah, that was kind of the way around I was. Brent, I can't remember. Did I answer your question, Brent, or not?
Yeah, we were just talking about how you would. Oh no, so let's go back to this the put option question, right? So I view put options now, they're very expensive, right? So if you want some downside protection, you have to get more creative with the way that you would arguably structure that, right? Because the payoffs are much different now with just the VIX over 35, right?
Yeah.
So how do you think about that? Like, let's say you were concerned that the Fed might really shake things up here, right? And may say, look, we're just going to raise rates. We don't care what the stock market's going to do. And you think the stock market's going to go down another 10%. Outright puts in that case may work if we get another 10% down, right? But realistically, how do you want to think about structuring?
Yeah, I mean, when vol's this high, the obvious way to be hedged is short calls and long put spreads, right? A put spread collar. Now, you might not want to sell super short dated calls because you might be like, well, we've sold off so much, we could bounce, like you just said, we could bounce 5% in a heartbeat, and then I'll get run over on being short dated calls. So then maybe you're going to look a bit further out. So the kind of trade you'd be looking at is maybe selling. So you wouldn't sell February calls, S&P. You'd look at maybe April. Maybe you'd say, by April, what do I get for selling like the 4800s, or even go as far as June, right? You'd say I could sell the 5000s in June. Because that could, 5,000 is quite a realistic target just for the market to top up there anyway, right? So you could sell the 5,000s in June calls, and that could be your funding of a put spread in March or something, basically, right? Mm-hmm. And that way you say to yourself, well, if this market's going to melt down, I think it's going to do it in short order. So I want that protection to March because the Fed is speaking, and rates are, there's momentum in rates or whatever. So I think that we're going to get our puke by March. So I'll own a put spread that gives me 5-to-1 leverage in March, and I'll fund it with a call in June, such that even if we do squeeze from here back to 4,800, if we then chop around or whatever, we don't break 5,000 by June, and I didn't lose anything, basically, right? So that might be a way to structure that hedge. I think you probably only do it as a hedge to being long a portfolio, but you probably don't mind overwriting your portfolio from these levels at 5,000 in June, given we've had that sell-off, right? That's nearly 20% out of the money now, that 5,000 in June. So you say, I'll make 20% of my portfolio between here and June, I'll take that, right? So.
Right. And so I guess the argument here is that unless you're trying to hedge something, your chance at sort of playing the downside via puts just as a function of betting the market's going to go down is you probably missed that trade at this point.
Yeah, I think so. I think it's
you're going to be paying
a tough
too
one.
much.
It's a tough one to be adding here. It's a tough one to be adding new put risk here. I mean, it's definitely a trade I want to put on at higher levels, but I thought that, this sell-off was a little bit quick and a bit early for me. I wasn't ready for it. I wasn't positioned for it. I was looking for a rally into February, March time for the VIX to get back to like 15-ish. And then I was going to be putting on some sort of downside hedges. Depending on what the vol surface looked like, I would have chosen whatever structures made the most sense for me at the time. But yeah, this sell-off was a little bit quick for me. Yeah.
I didn't. Oh, there you go. Another question there.
All right. When VIX extremely high like now, will a call calendar spread be a better choice than a bear put spread to sell VIX? Since the put is so expensive to buy at the moment. A call calendar spread. So you would be, which way round? So you'd be selling short dated VIX calls and buying next expiry VIX calls. Like, I'm always a bit sell short dated VIX and buy. Yeah, I'm always a bit wary of that trade because what you're doing there is giving yourself pretty unlimited exposure, right? Like if this turns into a full-blown crash, a short-dated VIX call is going to bury you, right? I mean, right now the VIX term structure is a little bit inverted, right? It's only about a vol and a quarter inverted between Feb and March, and the same about a vol between March and April. If you do that call calendar, that shit can go 10 vols inverted. I've seen that before, right? So, it's a very dangerous trade when you're short the crash like that. It's not something I'd feel particularly comfortable doing. Yeah. And also kind of limiting how much you can make, right? You're not going to make that much out of selling those calls either, I don't think, right? But yeah, I don't think I'm a fan of that trade as an alternative to the put spread on VIX, basically, right? I mean, the way I've often played the kind of put side on the VIX when the vol's quite pumped is I've basically bought the front put on VIX, but I've sold multiples of the next month puts with a lower strike price, right? So, for example, right now, you've got Feb VIX, well, let's say March, because Feb's probably a bit soon. Like, you don't know if we're going to normalize by Feb, right? So if you look at a March VIX at 29.25, April VIX at 28.25, right? So maybe you could buy a March put on VIX, struck at something like, I don't know, right? Something like 22 or something, okay? Then you can sell an April put on VIX, struck at 20, but you sell multiple size of the April, right? So by doing that, you benefit from a normalization in the curve where your March goes below April. So along the 22 put in March, you short the 20 put in April times 2. The reason you've done the ratio is so you don't actually buy VIX vol. You keep your VIX vol exposure down. That's because you've sold extra options. But you've done it via that calendar because in a normalization curve, March is going to trade 1 to 2 vols below April if everything calms down, right? So that would be, for me, the alternative to a put or put spread on front VIX, basically. Yeah, it's a tough trade it's not foolproof, but it's kind of, that's a trade that could work in that scenario. And it is one that I've traded before. Yeah, when I was in the banks and the hedge funds. I guess one problem you have is margin, right? To sell double the size of the April VIX put, you're going to be requiring quite a lot of margin because VIX is a high vol asset. That may make it hard for a retail guy to do that, right? All right, how do I balance Greeks in a long short portfolio? What do you want to elaborate on that, Hollis? I'm not really sure what you're asking me.
Yeah, so just say you got a portfolio of say 10 trades, 10 spread trades, and
Spread trades.
some more spread trades. Well, just say you got like 5 calls, 5 puts,
Okay.
all with like spread trades, right? And you got that's what's that 5? That's 10. Is that 10? 5 calls, 5. No, that's 20 then, isn't it?
Oh, so you got five call spreads and 5 put spreads. That's what you're saying.
Yeah.
Okay.
So you got like 20 individual option trades there, and you have some more longer dated and some shorter dated. So one has more gamma risk than others.
Yeah.
So within a portfolio, and you want to be neutral, how do you manage it so that the short dated stuff doesn't overpower the longer dated stuff? If you get what I mean.
But when you say in a portfolio, you want to be neutral. What do you want to be neutral? Theta or gamma or what neutrality are you looking for? I guess is the question, right?
Just say mainly delta, I guess. So just say the market sells off and you're on a shorter dated, you have shorter dated puts on.
Yeah.
And then the market sells off, and then those puts, the delta on those puts grow faster than the longs. Then you're more heavily weighted on the short side. So how do you look at all your Greeks so that you can neutralize it again?
So, but are you trading, like, what's your motivation for trading the spreads in the first place? Are you playing directionality or are you playing volatility? Like because like by definition, like a spread trade, like a put spread or a call spread, like if you delta hedge it up front, it's actually quite a complex vol trade, right? If you trade it for its directional properties, i.e. its delta and its payoff profile, then the predominant thing you're trading and playing is the delta, right? And you can monetize that with stock, you can monetize that with exiting the position, whatever it is. But my point is, what you do and how you manage your portfolio is a function of why you're doing the trades in the first place, basically, right? Are you doing those spreads to play a directional view, or are you doing them for some other reason?
Play a directional view mainly.
Play a directional view. So rather than looking at the portfolio as a whole, because you're playing those on a directional view, the thing you need to be most concerned with is whether your delta view is changed or not, basically, right? So you're putting on a position on stock or an index as a call spread or a put spread to play the direction of that asset, right? If that asset moves, the decision to hedge or take profit or whatever is a decision based on a change in opinion about the direction of that asset, right? Now, why did you do a spread in the first place? Probably to keep your carry cost down, right? And not buy too much Vega, right? But then once you get the directional view, it's like, okay, well, all right, the only time you need to really meddle with that or do anything, because remember, it's not so explosive that it's going to have loads of Vega on it or loads of theta on it that you have to pay, basically, because it's a spread in the first place, right? So if you're getting the move in the direction that you want on that asset, you've pretty much got one or two, you got a decision to either do nothing or to take some profit, basically, right? Because the move is done for you, basically, right? And then that decision to take profit then becomes, do I just delta hedge it with some stock? Because I think it's a short-term bounce and I don't want to exit the whole position, but I just want to buy some, say it's a put spread and we go down, buy some stock against it with a view that if we bounce, I'll get rid of that stock again and I would have just traded around that position a bit. Or is it a case of I structurally don't need this put spread anymore? It's done what I thought it was going to do. It's given me some leverage. It's made me some money. Now I want to take my money and run. And then you just exit the position. But I would recommend as a retail guy, for sure, trying to keep your book as clean as possible, right? Like you don't want positions all over the book and then have to manage like 20 positions. And because you don't have the risk management software that's like in-house in a bank or whatever. So it's a headache, right? It's a bit of a headache to manage. So I would try and keep things clean and be like, is my view, why am I doing the trade in the first place? What's the optimal trade to do to reflect my view? Stick it on, and then only mess with it if your view actually changes. And anytime you can get, you know, if it's a decision between adding more messy positions or cleaning a position, I would always go towards the cleaner version, right? So you have less stuff to manage, basically. As a retail guy, you don't want to have a scattering of 20 options to like deal with. It's not a lot of fun, basically. It's not a lot of fun for a bank guy, let alone a retail guy. Yeah.
Yeah. Thanks.
No worries. Right, we got any more? How many people we got? 8 people. Hey guys, anyone who hasn't asked a question or wants to give us any feedback or say hello, feel free, yeah? Hopefully you guys are enjoying the hedge course, finding it useful. So Brent, you still there?
Yes, sir.
So what do you fancy? I mean, I fancied a rally. I fancied a rally. There's an echo there. You can put me on mute.
I think I got to mute.
Yes, so I was looking for a bounce into FOMC on some optimism. We had the flush out yesterday. Can I mute you? So I thought we had the flush out yesterday, and I thought people would be looking for the Fed to kind of appease the market a little bit. So there might be some short covering into the FOMC, and then actually they end up to appease the market and we go down again. That's my path, basically. What do you think?
Seems like we're still heavy.
Yeah.
This is Val. Yeah, that would be a good scenario to rally into tomorrow's meeting, but seems like we're still heavy in the.
Yeah, we're definitely heavier than I expected.
Maybe we see a bounce after that, but who knows? Are you? Let me ask you a question. I'm Val. Nice to meet you. Good course. I just looking at that. I'm trading futures options. You trade future options at all?
Not so much. Stick to S&P or ETF like spiders or something like that.
Yeah.
But
well, I like trading S&P options, but I also trade. Most of the market that I trade is crude oil. I trade a lot of agricultural, corn, wheat, soybeans. I trade a little bit of gold, but mostly agricultural, crude oil, and S&P. In S&P, it would be nice to take advantage of this hedger premium. You know, the options are so expensive on the put side. You know, is selling the futures versus puts and protecting it with a little calls sometimes work for you? What do you think?
Yeah, that can definitely work. That's just a
like
short.
Take some.
That can make sense.
Yeah, as long as you're not losing and making time value, right? Have you tried anything?
You want to structure it so you're earning, right?
Yeah, but at the same time, certainly on the big moves, you know, when you sell a lot of puts, even the overpriced, you are really, you know, the moves like yesterday.
Yeah, that's why it's a good idea to fly it off. Like, so you kind of sell like that echo. So
Sorry about that.
No worries. Do you mind muting while I talk and unmute when you talk? Otherwise, no one can hear properly. So yeah. So the what I was saying was, yeah, when you want to sell that skew as a retail guy, it is tough because being short that unlimited tail to the downside can be a bit difficult, and you have to post a lot of margin, and you don't want to lose loads of money on the way down. So flying it off, so doing some sort of fly structure where you might own at the money to slightly upside, you might be short the kind of 25, 30 delta downside, and then you own some of those 5 delta deep downsides, which obviously are expensive, but they're so low premium that you can kind of live with the fact that they're expensive because they're not actually going to lose you that much decay. And then you're still structuring the book short skew, but you can't blow up too badly because you contained your risk, right? So then if skew does compress, because you got 2 shorts on that juicy 25, 30 delta put area, then you can make some money from skew compressing. But to be honest, as a retail guy, it's tough making money off implied skew moves, right? It's not, that's kind of a hard way to make a living, right? I'd say. Yeah, I'd rather focus on delta trades using optionality than playing the parameters like a market maker or a bank trader would, because you need a lot of tools for that. You need to be watching the market all the time. You need to get good liquidity, getting in and out of stuff. It's quite a challenge, basically, right? Even the guys who have all that at their disposal struggle to make money trading like skew parameters.
Yeah, you're right. It's nothing easy in the markets, but it's certainly much easier than trading futures on S&P lately. If you build a position, short futures, short puts, something like that, protect with some calls, it's so much easier than being short along the market. But you're right. We're trying to do something, at that respect. It's not bad, but it's just, there's so many, smart guys, doing this option S&P trade that it's really tough to compete, in the sophisticated, markets like that.
You mentioned that you trade agriculture and oil. Are you bullish on those right now? Trading.
I'm currently in Ukraine, I'm in Ukraine, so am I bullish? I don't know. If Russians moves in, I'm really bullish. I've heard. I think JP Morgan said that we could see, wheat and corn market flying, like there's no tomorrow.
Yeah.
We could see moves. I don't know. The double, probably not, but we could see, huge moves.
What about oil?
Oil, crude oil?
Yeah.
Well, everybody's bullish crude oil, but certainly, you get a little nervous when everybody bullish, but why not? It's just it's not giving you. Try to correct the last few days, but it's heading tough. It's another interesting markets. I'm surprised you not looked at it. Those option premiums are so rich in oil, but man, this political risk. Somebody gonna bomb something, it's even worse than the stock market.
I do look at it. I do look at oil. I just don't trade them very often. Because like you say, the vol is expensive, but it's usually expensive for a good reason.
Well, that's usually the case. In oil is the worst in S&P, the other day pipeline blown, this, that, Russia doing something, you certainly could wake up and see, $5-6 moves, no problem.
Yeah.
But, I never traded the stock options though. I think I should be. They say it's easier to trade than the future options. What do you think?
Trade what? Stock options?
Yeah, I never traded stock options. I always traded futures options. Options.
I don't consider them to be wildly different. Like, to me, semantics. Option on a future or an option. Like the asset is the equity. If it's a future on an equity, or if it's by ETF. The same product. Like the movement, volatility. As long as you know how the settlement works, and you don't get to like exercise, you don't do something silly like that. I usually just trade out of all the positions before expiry anyway, so I don't even care about the kind of the semantics of how the expiry works and stuff, right? But for me, I'm indifferent between trading an E-mini option, an S&P index option, or a SPY ETF option. I mean, there's differences between the commissions that you might pay and things, and the spreads on the screen that you might get, but ultimately they're the same asset, right? That's the way I see it.
Yeah, you're probably right, but still, I don't have much experience in that. Thank you.
Right.
I have another question, but I'll let other people talk.
Someone said, what strategies do you think with delta trades? That's from Peter. I'm not really sure what the question means, Peter. What strategies do you think with delta trade? Are you saying what strategies do I use to express the delta, to express a delta view? I mean, that can be any strategy, right? I mean, there's so many that can express a delta view, right? But typically it's going to be an outright put or call, or a put or call spread that are gonna have a delta on them that you're expressing a delta view. If you don't want a delta view, you might do a strangle or a straddle type trade. If you want to be fairly delta neutral but play the curve, you might do a calendar type trade. What do you recommend you use for a retail trader when you use delta strategies? Yeah, I think that's just too broad a question to answer. It really depends on what the underlying is, what's going on in the stock, what the vol surface looks like. There's so many, but the whole point of the course is to give you the framework as to how to come up with that answer, right? So the idea being that you're bullish a stock. If you just bought a call option, yes, you'd have delta, but you'd have these other Greeks to worry about. How do you feel about those Greeks? Do you want them or not? How do you make that decision? You look at the vol, you look if it's high or low, you look how the thing's carrying. And then if you decide it's too expensive to just buy the outright call, then you look at a call spread or a call ratio. It's a step-by-step process that gets you towards the strategy that you want to go to reflect your views, find your risk tolerance, and find a cost that you think is viable to, spend on that trade, right? That's the idea. Cost benefit analysis, basically. Yeah. Val, do you want to ask a second question?
Well, let's talk about this delta trade. For example, imagine for a second you're not watching but trading crude oil market. For example, you buy a future, one future of crude oil, and you buy, say, 2 puts or 3 puts, whatever. You delta neutral. Then the market goes down $1. You out of like $1,000 in the future. The puts more or less made you probably $1,000. How do you manage that position? You're supposed to get out of the put. Я на конференц-коле, я перезвоню через минуту. You're supposed to get out of the puts, right? But or you probably to delta trade, you probably have bigger multiple positions, right? Like many futures, many options, because you can't manage this delta trade if you have just 2 small 1-2s, right?
Again, this boils down to trading. Can you put that on mute again? This boils down to if you're trading this as a vol trade. So let's say you bought 2 puts and you hedged them with 1 future, and you said that was delta neutral, then you are effectively long volatility, long gamma on oil, right?
Absolutely, yeah.
So then if oil moves, then the delta of your position is going to change, right? The delta of the puts is going to go from 50 delta to 70 or 60 delta or whatever, and the delta of your futures is unchanged. So you will acquire some negative delta on the way down, which you need to decide whether to buy that delta or not, or let it run, right? If you let it run, then you're going to keep acquiring more and more negative delta as the more the thing moves. But if the thing mean reverts back to unchanged, then you're not going to have anything to do, and you're just going to bleed time decay, right? So that becomes a decision about trading the vol, to try and make back more money than the time decay costs you, basically, right? And that's a gamma trading decision, basically. If you're when you delta hedge your options, you become a gamma trader, basically, right? You then have to suffer the time decay every day and fight to make it back via trading your gamma, basically, right? When you're not a delta hedger and you're just doing options to express directional views, you still need to take the time decay on the chin. It's gonna cost you, but relative to what you'll make on the delta, if you get the direction right, then you don't care so much about the time decay, right? That's the idea. So as a retail guy, because you might not be staring at the screen, hedging the delta all day long and trying to capture that volatility, you're kind of fighting a bit of a losing battle if you then go and delta hedge your options and then walk away for half a day, because you're going to pay that time decay regardless, right? If you're not there to make the scalping money, the buying and selling around that gamma, then you're just paying that decay for nothing, right? Whereas at least if you do a naked option trade with a load of delta on it that you don't delta hedge, you can walk away for half a day. But if the market moves in the direction you want it to, that far outweighs the theta bleed, because the delta is the bigger Greek to worry about, basically. Yeah.
Right. Agree.
Okay, cool.
How about sometimes I do, when I expect a big move, sometimes I try to sell an expensive option, for example, at the money option, or even slightly in the money, and try to buy two options out of the money. Certainly pay a higher volatility and higher price on those two options, but if you do it for the same price, and if you do indeed get a big move up or down, certainly a good strategy. Can you critique it, or
Yeah, so that's called a back spread strategy. People call it a back spread, short ratio strategy. There's a time and a place for that. It depends on the level of the skew, depends on the level of the vol. It also depends on like what you think will happen to the vol if you get a move, right? So when you do that trade, it's usually quite delta neutral. It's often quite Vega neutral. So you've neutralized a lot of the Greeks from day one, right? So actually, often the biggest Greek you've got, or the biggest kind of risk you've got, is the skew risk, right? Which is basically the different volatilities for the different strikes that you're running, right? So when you're getting into that trade, probably one of the biggest considerations needs to be, if spot goes up or down, what happens to my Vega position? Because it's going to get longer or shorter. And what do I think about the level of the vol, and where the level of the vol will go if spot goes there, basically, right? These are the considerations you need to think about, because that's kind of going to be the major driver of how well that trade does or doesn't do. Yeah.
Thank you. Yeah, I agree. I mean, this is a trade when you think when the market going to move really fast, really quick. And if it's not doing that, then you have a lot of problems in that position.
Yeah, exactly. Again, not really a position I do very often from a retail perspective. I have occasionally done it when the skew has been very extreme and I thought it's overdone, it doesn't make sense, and there's been various reasons I've done it, but it's not something I do very often as a retail guy. I'm usually the other way around. I prefer doing it the other way around, buying one and selling the 1.5, or selling two, or whatever.
Yeah, that's called the option tree. You buy in the money or slightly in the money or at the money call, and then sell a call higher strike price and then sell another one. But you're going to get in trouble if the market going to move quick up. I was in trouble this summer with the grains in that strategy. I thought we were going to go up, but slowly. But when we really moved higher, I got a two position against one, all of a sudden, and that cost me a little bit of money. Right. But usually that works. That's better odds. Better odds when you sell more.
Yeah, you want to rally into your short strikes. They're decaying nicely, and you go through.
Right.
Well, I think we've run over by 5 minutes. So if there's Matt, do you want to quickly say hi? we'll probably need to call it a day, right?
Sure, sounds great. I don't want to take up anybody's time on this call with corporate nonsense, but I do really appreciate everybody that joined and signed up for the Academy and being here with Imran. Just high level, again, this is meant to be a supportive Q&A, so thanks for joining. We'll be putting these, again, into the entire Academy system, so you can see these following up. Still have access to more of these with Imran, and hopefully you can see from today how great Imran is at figuring out trading ideas and structuring things and thinking real time for his macro insights course that you have a month access to. And at Spot Gamma, we're continuing with everything we're doing, and we're launching our real-time indicator hero here in the month of February. And we just put out a YouTube video yesterday analyzing the moves yesterday. So you could see that at the bottom of the 4% down move on the S&P, there was a big jolt in the amount of puts being sold, which drove the market higher. And we put out a YouTube video on that yesterday on our Spot Gamma YouTube channel, which is there and free. So just want to say thank you guys. Thanks, Imran, as always, for covering so much awesome material. And good luck trading to everybody in this crazy environment.
Thank you very much.
Thanks everyone for coming.
Thank you.
Take care, guys.
Matt, do you mind staying on? Want to have a quick chat?
Yeah, let's close this out and then I'll call you.
Okay, cool.
Okay, thanks, bye.